Hey there, BrentWofford here, Arizona Rad Realtor. Today I am joined by the one and only Sasquatch in lending, Mr. Greg Riordan with Legacy Mutual Mortgage. Greg, how you doing today?
Good, thanks for having me.
Absolutely. Today we are going to be talking about a myriad of things. First thing is going to be kind of going over the mortgage process for someone who's a first-time home buyer or somebody who maybe hasn't bought a home in, 10, 15 years,
Sure.
20 years? What's changed? So
Yeah.
I want to see it from
What
your
hasn't
perspective.
changed? Yeah.
Yeah, what hasn't changed? Pretty much everything, right?
Yeah.
We'll go over financial preparedness and a strategy that you can give somebody if they're thinking about buying, things they can do before they actually meet with you to do a first consult, right?
Sure.
And then we'll wrap it up with some tricks, as the best way I'm going to put it, for lending and for being able to change your payment, whether that be temporary or permanently. But we're going to save that tip for the end, so you'll have to stick around and find out what that is.
Yeah, using area data to get the best lending strategy for the lowest rate, payment, and closing costs.
All right, well, let's dive into it. What do people need to know about the mortgage process? So first question I'm going to tee up to you is, what's the difference between pre-approval and pre-qualification? So we hear people will say, oh, I'm pre-approved, or oh, I'm pre-qualified. So from a lender standpoint, what does that actually mean?
So pre-qualification basically means I've had a conversation with you, I've ran your credit, I've looked at some documentation, I've looked at the systems called AUS, automated underwriting systems, and gotten approval based on those parameters. So that'd be a pre-qualified. So we've looked at everything, and we've then issued a pre-qual letter saying, yes, you qualify within these parameters, but we still have to go through underwriting. We still have to do all the due diligence that we have to do with all the follow-ups and checks and balances, looking at all the paperwork even deeper and have an underwriter bless it. Pre-approval is basically saying, hey, I took all your information, I did everything up front, took all your financials, and I sent it up to an underwriter so that they could bless it and say, yes, we're not going to have any issue. 100%, they're already approved. And they give their approval, and we get it back and say, now you're pre-approved. So that takes about 24 to 48 hours, roughly, depending on the pipeline of the underwriter and how busy we are.
Yeah.
Yeah.
So which do you recommend, or would you suggest somebody who's a first-time buyer, which process to go through, pre-qual or pre-approval?
Well, I would say pre-qualification usually is okay if you have a fixed income, you've been at your job for 2+ years, there's no variables, you have good credit, you have good assets, right? Meaning you saved enough money. But if there's any variation like, hey, I jumped from job to job, there was a break, now I'm went from salaried hourly to commissions, variable, bonus. Maybe I'm now a business owner and the calculations are kind of funny. Anything that, in my opinion, what I do is if it looks slightly off, I'll just have an underwriter bless it real quick. So I would say if you're plain vanilla, maybe even fixed income as a retiree, probably no issue, right? Your credit's good. That's a qualification's just fine. If you're in between, right, you've retired, but you're not quite getting retirement income and you're using other assets, depending on the lender and how smart they are or how they know how to use the rules to the advantage of the buyer, you might want to put that in front of an underwriter.
Okay.
Make sense? What do you prefer as a realtor receiving a pre-qualification for a listing? When you're looking at it, you're saying, hey, how are you weighing the differences? Because I know you know the difference between pre-qual and an approval.
Typically, we don't have multiple offers in this market, but when we did have multiple offer situations, that's when it would be heavily weighed and considered.
Okay.
So obviously, as a listing agent, if I've got five offers that come in, and one's cash, one's pre-approval, and one's pre-qualified, what I'm going to do is put them in order. Just say the terms are the same, obviously cash is king because there's no appraisal.
Right.
So, but if there's no cash offers on the table, we're probably going to give more credit to one that's a true pre-approval instead of a pre-qualification, because we know they've already gone through the underwriting process, they've already been blessed by an underwriter, and they're more solid of a buyer. Not necessarily that they're more qualified, they just have done more in its
preparedness,
but also like confidence in that buyer's ability versus confidence in a pre-qualified buyer's ability. It's more of a crapshoot.
Yeah.
Because you don't know, like you do your due diligence, but there's other lenders out there who don't, especially with these third-party companies that people find online, where they just send them their income and they give them a pre-qualification letter based on what the buyer told them. Not necessarily everything has been verified, assets haven't been verified, all that stuff. So without getting too much into the weeds, definitely a pre-approval carries more weight in an offer than a pre-qual does.
Awesome.
The next question, how many different types of mortgages are there?
Oh, goodness. If you can literally think of a situation, there's probably a loan that could fit that, barring bad credit.
Okay.
If you have good credit, even decent credit, and you have a weird situation and enough assets, there are so many ways somebody can get a loan. It's unbelievable.
You want to talk about the main different loan programs then?
Sure. The
main ones. The weeds, let's keep it to like the top 5 maybe? Or
plain vanilla, you're looking at conventional with Fannie Mae, Freddie Mac. You know, that's anywhere between 3% down to as much down as you want. FHA, 3.5% down. That's really lenient and tends to be more of a first-time home buyer or somebody who has challenged credit. They're a little bit more lenient with those parameters. You have VA for veterans. Those are amazing loans, and today they're not like they used to be, where they were real cumbersome for everybody. They're very fluid. So you get a VA loan, don't freak out if you see that on a pre-qual. These are really good things.
Yeah.
And then you have a USDA loan. That's a no down payment loan, but you still need money for closing costs, right?
Yeah.
So those are the main ones. Typically, what you see is the first 3: conventional, FHA, and VA. USDA is very rare. It's made for rural communities, so it's unlikely you'll see many of those.
What about if I want $1 million loan? Which one of those can I use?
Well, you can potentially $1 million loan, not a purchase.
Loan, yeah.
Loan.
Yep.
So VA, there's no limit.
Oh, that's good to know.
There's no limit, but the veteran has to qualify based on their income and debt to income ratio, right? And that's, generally speaking, that's not the real rule, but it is like their income has to support that monthly payment, okay? Now the DTI ratio can be higher, which means they can absorb more debt or have capacity for more debt than a conventional loan could.
And then, you didn't bring it up, but I want to bring it up, jumbo loans.
But yeah, I mean, jumbo loans are great, depending on what lender we're using, because we have a variety of different lenders we use for jumbo loans. But you're going to be under a lot of scrutiny. You really have to be like under 35% DTI in most markets. Now there are factors that can mitigate that, but you're going to be under the microscope a lot more, and rates can be on par with everything that's going on in the regular markets, but depends because you're more scrutinized. If anything's off, rates going up, right? So there is mitigating factors that offset rate and everything that you're going through. Also, jumbo loans sometimes require 2 appraisals.
Oh, interesting.
It just depends on that lender. So if I say I'm going to Chase or I'm going to Wells with it or I'm going to go to New Res or the other 4 or 5 that I can go to, they have different rules depending on how much it is.
You mentioning going to different lenders.
I have a broker capacity.
Okay.
So I am a direct lender to a certain degree.
Okay.
I can correspond to Chase, Wells, New Res, all the other Redwoods and all the other dozens that we correspond to.
Okay.
Okay, so that means we're basically underwriting in-house and then selling it to them.
Oh, okay.
Broker, I have the capacity to do non-qualified mortgages, which is the variety of think of a scenario, we can get you a loan, we broker those.
Got it.
Okay. And so while we have capacity in all 3 to choose who we want to use if it has a better rate. Maybe I'll go to Planet today versus Penny Mac, or maybe I'll go to, like I said, one of those big banks. Depends on what my pricing sheet pops up, and we look at those different ones.
Yeah.
So we can pick the best one for the client.
So how does that benefit a buyer? specifically? Because you can shop rate and potentially get them the best rate? Is that how that works?
Realistically, yes, right? Because I'm choosing from these dozens of lenders that are out there, and I'm saying, hey, here's the best rate. I don't get paid any different, right? So it's in the best interest to act of the client, like, hey, this is the best rate, and potentially, depending on their situation, maybe we have to use this lender because it fits better. Their rules are slightly different than the other lender, right? So we look at those depending on one rate, but also the scenario and circumstance of the client.
Okay.
So
yeah, we talked a little bit about underwriting, and you had mentioned sending, like on a pre-approval, you're sending the file, the package, the information over to an underwriter. Can you dive a little bit more into like explaining to a first-time buyer what is an underwriter, who is an underwriter, and what they do, and kind of their process in a nutshell?
It's a man behind a creepy curtain.
Dr. Oz, or not Dr. Oz, the Wizard of Oz.
Wizard of Oz. So an underwriter basically is saying, is this loan sellable on the secondary markets? It's saying, does it check all the boxes where I can go and after we close and make money on it in the secondary markets and sell it to, like we said, those other lenders, right? And or Freddie Mac or Fannie Mae or Ginnie Mae, Sallie Mae. And so they're just making sure that it fits the mold. That's it. I mean, that's in essence what they're doing. They're not trying to make your life more difficult. They're just trying to make sure that all the boxes are checked so we can sell the loan. That's it.
So do they make your life more difficult?
I've been doing it a long time, and depends
That's
on
a
the year.
question.
Yeah, depends on the year, right? Like the risk tolerances that the government pushes into our systems, and they say, hey, the risk tolerance is going to be XYZ this year, and you're like,
yeah.
Or they open it up a little bit, and they're like, hey, we've changed some rules around. I mean, it can be depending on the year and what administration is doing to lending. So
just for clarification, it's not the underwriter that's changing those rules. They just have to abide by.
They just have to, and we're just the messenger, right? And we're going to try to make it easiest.
Well, they are too,
yeah, and we're just trying to make it easiest on the client, right? We'll ask for as least amount as needed, so that it's not a paper factory going through,
So another question is timeline of a mortgage. Can you kind of walk us through the typical timeline? From when someone first talks to you to when we actually get to the closing table, and how underwriting kind of fits in there.
Yeah.
Obviously we talked about underwriting as a pre-approval, doing underwriting ahead of time. But you and I both know, and maybe we explain this, that it does need to go back to underwriting again with the information on the house, so then they can pair. Can you kind of talk about, just in a nutshell, real quick, kind of go over the timeline of the mortgage?
Sure, you can do the pre-qual, the pre-approval up front. Then I'm going to send you back to Brent, and Brent's going to say, okay, here's the parameters of what you're qualified for. You're going to negotiate, hunt, get in contract. I get the contract, and then we put loan estimates together, which I've already shared with them beforehand, so it's not going to be anything different. They sign the loan estimate. We order the appraisal. The appraisal comes back usually within 2 weeks. During that time, we are preparing processing and going into underwriting and coming out of underwriting. Once the appraisal comes back, it's reviewed. It's shared with you, the realtor, shared with the buyer. If there's any more negotiating that needs to go on, that's done at that time. And then we get the closing disclosure out, which is also known as the CD. And that's basically all the vendors that are involved have been now verified and invoiced all the costs. And so that number should shrink, not get bigger.
Yeah.
If it gets bigger, call me.
Yeah.
So it should shrink, and then we're going to close. Loan docs will go out, and then the signatures happen. Depending on the lender, we can do a hybrid where a remote goes out, you sign some on DocuSign, and it comes back, and then you sign the other half with title, and then we basically get those back, record, county records, and then the house is theirs. And that's typically within 30 days. It can be sooner if you have an appraisal waiver or appraisal's already been done. But don't get an appraisal before
Yeah, huge disclaimer. Don't get an appraisal before.
Do not.
No, because you're going to have to order another one. But like the appraisal gets ordered through you, but you don't get to pick the appraiser, right?
Right.
Can you kind of give some insight, shed some insight on that and how that has changed since the 07, 08, market correction?
Yeah, before that, Frank Dodd and all that stuff went in 2000, TRID kind of went in 2015, and maybe even before that, you could order an appraisal from your favorite appraiser, and you'd be telling them, hey, I need this to come in at this price. Today, we have to go through, and that caused us all sorts of issues. But that's like 2008 issues, right?
Yeah, that's why I brought that up.
And so we don't have those issues anymore because we have this governance board called a appraisal management company, and they basically have panels of appraisers, and we just send up the work order. The appraisers pick it up for that market wherever they're located, and they have to then, after the work is done, send it to the AMC, appraisal management company, and they have to review it before we get it, and then we have to review it. And if there's any issues or challenges that need to be updated, we send it back to the AMC, then send it back to the appraiser. So there is a little bit more lag time, but I will tell you that there's not a whole lot of discussion between the realtor and the appraiser or the lender and the appraiser unless something really has to change.
Yeah.
So.
And in a nutshell, that's why we don't recommend anybody hire their own appraiser, buyer side or seller side, before they actually go under contract.
Because the financial institutions can't accept it because we have to receive it a certain way, under certain parameters and with certain ownership.
Yep.
And so just don't do it.
Yeah, exactly. So you mentioned a little bit about costs. Let's just wrap that up or wrap up the mortgage process on understanding closing costs.
Yeah.
Essentially, what a buyer's going to expect to pay, if you can, not just going over straight numbers right now, but just kind of in a nutshell, like what the different fees are. And
sure, you should expect like 2 to 3%, depending on loan amount, of what closing costs are. But part of this, the biggest cost in there is, I will say, prepaids. Prepaids are your taxes, property taxes, depending on when you're closing in chronological order. Title will tell us, hey, we need 1 month or we need 6 months or somewhere in between, right? So you're collecting property taxes for escrow, which is your monthly payment escrow account that's included in your mortgage. Homeowners insurance, we're collecting 1 year's property tax. So that could be, $3,800 of your closing costs for that 1 year. And then we collect a couple months for padding for that escrow account so that when it all comes due, it's being paid appropriately and we have enough money for the next following year. Because you're basically insuring yourself for that full year first. Yeah. And then collecting in payment so that we'll insure you for the next year because we collected for that whole year. Mm-hmm. So that would say that's probably the biggest portion of cost. And then depending on if you pay points, we'll get into that later. Yeah. But you should have like the title fees. That's probably the next biggest because you have lender's title insurance, you have a CPL, cover protection letter, you have endorsements, you have escrow, which is a settlement fee to handle all the monies from the sellers, the buyers, and dispersing it to all the right people and the lender. And then you have a title fee, the insurance to convey names and all that. So that is probably 80% of the cost. And if it's not, call me. But then you have the lender fees, right? You should have like an underwriting fee potentially, a processing fee potentially, and then maybe verification of services and maybe a credit report. And then also maybe if you need a traveling notary, which would fall under title, and then appraisal fee. Yeah. So that shouldn't be as much as the other two. If it is, it's probably because you have points, which is trying to buy the rate to whatever rate you have. Yeah. So.
Cool. Thanks for the breakdown on that.
Sure.
And then also you need to know that on the agent side of things, there were rule changes that happened with the National Association of Realtors last year. So now as a buyer, upfront, you need to know that you could be paying for your agent services as well. Where in years past, there was nothing was ever set in stone, but years past, 9 out of 10 times, a seller is going to pay for a buyer's agent services. Now it's all up for negotiating in the contract, in the deal, and we do our best to try to negotiate those fees. But ultimately, there are buyer responsibilities regarding an agent like myself, our services.
So if I understand you right, Brent, it's really that one-off that the seller isn't providing that broker fee. Mm-hmm. Okay, but like you said, 9 out of 10 times it's happening.
Yeah. Well, we have to negotiate it into the contract.
Sure.
So there's nothing set in stone anymore where prior to August of last year, a seller could advertise, hey, we are offering a blank percentage as a reward for a buyer's agent or a buyer's agent fee of a blank percentage to cover buyer agent costs. Well, that got decoupled last year, so now buyers are responsible for their own agent. And to offset that, just like we can offset closing costs for escrow, title, and lending, we can now offset closing costs for the buyer's agent into the contract.
Great.
Yeah, so that's a kind of a wrap on the mortgage process. Let's take a quick little break and come back. Thank you so much for joining us today on the Northern Arizona Real Estate Podcast with special guest Greg Riordan of Legacy Mutual Mortgage. Unfortunately, we ran out of time today to cover lending strategy tips and tricks that Greg has, so you're going to have to join us next week as we go over that. We'll pick up where we left off. Until then, I hope you have a rad week.